This week on Sylvia's Traders Lounge.
His options provide flexibility. You can really create any strategy you want, any risk reward profile. You can do anything you want with options if you just get creative. Options tend to provide less volatility in your account. If you're right, you're going to make less probably with an option spread than you would if you just went out right long or short a future, but you're going to lose less if you're wrong. And so there's definitely something to be said of that with that, because we're not all of us are always right. And there's basically options provide a little bit of diversification, especially if you're trading spreads.
Sylvia's Traders Lounge welcomes you all to yet another webinar where we learn, trade, and profit. We shall be giving you trading insights on technical analysis, fundamental analysis, risk management, and trading psychology.
All right. Hi, Carley. How have you been? It's been a while since we did this.
It's been a while, absolutely, and a lot's happened.
Yeah.
No dull moments in the markets.
Yeah. So the last time we spoke to you was in November. Maybe you can tell us how your trading has evolved since then. And then maybe you can take us through your live trading examples.
Sure. So, obviously, honestly, we can stretch back the last couple of years from 2020 till today. We've just seen so many unusual historical events. We had a pandemic, we've had a war, and possibly even a World War III scare. We've had all kinds of weather issues if you're a commodity trader. So there's so many moving parts here. It's honestly been a pretty rough couple of years for most commodity traders. I know that's not the popular narrative because people are seeing commodity prices move. There's a lot of volatility, and earlier in the year it seemed like commodities were just basically go long and you couldn't go wrong, but that really is proven to be not necessarily the case, because as I've learned over the years, commodities can rally, and they can rally really sharply and in a stunning fashion, but they're rarely sustainable. And the reason being is commodity prices get high, producers start producing more product because it's more lucrative to do so. So there's always this battle between when prices go high, more supply comes on the market, and when prices are low, supply comes off because producers and end users are reacting to those prices. So commodities don't go up over time like stocks tend to. Instead, they just trade sideways, and sometimes that sideways action can be extremely volatile. Like we've seen in crude oil, we saw crude oil rally to $130 a barrel. And then just a week or two ago, we made a low of $80 a barrel. So we're talking a $50 swing in crude oil in a couple of months. So it's been really, really tough. It's great if you happen to be on the right side of it. It's not so great if you're on the wrong side, because it's difficult to manage risk in that kind of an environment. So I would say with most commodity traders, they've probably hit home runs on some trades and just got completely squashed on others. So there's no easy money and no free lunches. That is for sure.
All right. Maybe you can take us through your live trading examples of recent trades. Yeah,
absolutely. I'm just going to go over to my desk and share my screen so that you can see what I've got going on. Okay, can you see my PowerPoint screen?
Yeah.
Okay, perfect. So just to introduce myself, my name is Carley Garner. I am a commodity broker with the Carley Trading. We're located in Las Vegas, Nevada. We're a boutique shop. So maybe you've heard of us, maybe you haven't, but we're a lot like, probably heard of some of the bigger names. But what we do is a little bit different. We don't offer everything. We don't offer stocks and bonds. We only offer futures and options on futures. And so we're able to streamline things, and I believe, in my opinion, we're a little better at doing it simply because that's all we do. We don't try to do everything. We just try to do one thing really well. If you're on social media, this is where you can catch me. My handle on Twitter is @Carley Garner. I'm on Instagram, Facebook, YouTube. I post a lot of dog pictures. So if you're not a fan of animals, maybe stay away from Instagram. Just a quick note on some of the things that we put out. If you do follow us on social media, you'll find we provide a lot of content for Mad Money. Some of the things we talk about today are going to be based on analysis that was on Jim Cramer's Mad Money. Also do Bloomberg Television, a segment called Options Insight quite often. Some of the things we talk about today were featured on the show. And if you're interested in learning more about trading commodities, now the commodities is a different animal than most asset classes. It's different than stocks, bonds, absolutely different than currencies. So it's not as easy as applying the same technical indicators that you use for stocks or currencies to commodities. You can do that, but it's not going to be the same because there's just so many nuances in the commodity market. So if you're interested in learning more, I highly recommend that you do a little digging before you jump in and risk your own money. And before we go through some trading ideas, I just want to reiterate that there's a substantial risk of loss in trading futures and options. It's not suitable for everybody. In fact, it's probably not suitable for most people. So before we look at a couple trades, I'm just going to run through some really quick slides to give you an idea of why we think the way that we do. Now, again, no free lunches, nothing is guaranteed. We're speculating. So in order for you to make money on these types of positions, you have to be generally right in the direction and generally right in timing, and it's easier said than done. So I'm not in any way insinuating that there's guaranteed profits, but if you do decide to speculate in commodities, here are some ways that may bring you into the markets with a little less volatility, a little more room for error. So the reason I focus on options as a brokerage, our brokerage focuses on options and providing our clients with an environment to trade options that is beneficial as far as margin goes, as far as access to trading products and that sort of thing. So a lot of people are turned off by options because of the fuzzy math that comes with it. If you're buying or selling futures contracts as opposed to options, the math is really easy. You can very easily see calculate what the profit and loss would be, what the risk is, that sort of thing. Options are different because you don't know how the market's going to react or how the option market's going to react to futures price moves, the volatility changes. So it's not as easy as calculating risk reward, at least before expiration. At expiration, you could do that. Before expiration, there's a lot of fuzzy math and that turns people off, but maybe it shouldn't because options provide flexibility. You can really create any strategy you want, any risk reward profile. You can do anything you want with options if you just get creative. Options tend to provide less volatility in your account. If you're right, you're going to make less probably with an option spread than you would if you just went out right, long or short a future, but you're going to lose less if you're wrong. And so there's definitely something to be said of that with that because not all of us are always right. And there's basically options provide a little bit of diversification, especially if you're trading spreads. And it'll give you some room for error, which is nice to have because again, none of us are perfect. Nobody's going to pick the high or low. If you give yourself room for error, it's going to take a little bit of the stress out of the equation. And options and option spreads tend to have lower margin and risk. It really depends on how you structure your spreads. So I don't want to say that that's an absolute statement because there are actually ways to put an option spread together that is that mimics the risk of a futures contract. It basically mimics the payout of a futures contract. So be careful, make sure you understand what you're doing. The biggest downfall of option trading is options are eroding assets. So they erode over time. And so the purpose of trading a spread or some of the stuff that we're going to talk about today is to reduce the impact of the erosion of that option. So in other words, instead of just buying options blindly and hoping for the best, generally it's a good idea to buy options, but use the market's money to pay for it. And what that means is if you're going to buy a call, maybe sell a call above it, maybe sell a put below it, or maybe sell 2 calls above it, whatever the case is, there's different situations that call for different strategies. The idea is to never pay too much for an option because options erode and most of them expire worthless. One thing I'd like to point out is trading is a mental game. It's 99% mental. That's not a scientific number. That's just my thought on it. So staying calm in bad times and humble in good times is a difficult skill to acquire, but it's the only way you're going to survive in this game. And one way to keep your mental wits about you is to make sure you have room for error and less account volatility. The more you see your account swinging up and down, the more stressful it's going to be for you. So if you're using options, hopefully those swings are smaller and less stressful. And if they're more comfortable, you're probably going to make better decisions. If you're, people that are under duress tend to make poor decisions because, stress does that to us. Whether it's in trading or other parts of our life, stress generally works against our ability to think clearly. So one more note about options is options are building blocks. You can basically take a combination of long and short calls and puts of various strike prices and expirations to achieve a common goal. And again, you can be creative with this. You can do it any way you want. There's no rules. Just make sure you understand where your risk is and what you're doing, because if you don't, there could be some surprises that are very unpleasant. The idea of an option spread is the antagonistic legs of the spread work as hedges, and the differences in time value exposure mitigate premium erosion obstacles. So the point is, be creative when you're trading option spreads. And if you are going to buy outright calls and puts, then there's a time and place for that. Be cheap. You don't want to buy options when they're really overpriced. And what I mean by that is when volatility is high. For example, when crude oil was earlier this year was skyrocketing from $90 to $130, it did it in a couple of days. And in that type of volatility, if you're purchasing an option after the fact, it's really difficult to actually make money because those options are pricing in extreme levels of volatility. And if we have less volatility than the market's already pricing in, your option is going to lose value very quickly. And I'm sure that happened to a lot of people. I know there were a lot of people when oil went up to 130, they were looking at buying 150 calls, 160 calls. Saw some 200 calls traded at really high premiums. I mean, people were spending thousands of dollars on these options. And of course, with time, they eroded to nothing. So that can be a pretty expensive lesson. Unfortunately, if you're trying to buy outright options after the market's already made its move, you probably missed the boat and you're probably just throwing good money after bad. So be careful doing that. You want to try to be cheap. When options are cheap is when volatility is low, but also take a look at the technical situation. So if a market's oversold, a lot of times calls are cheap. If a market's overbought, a lot of times puts are cheap. And you don't have to buy an at the money option. You can buy an out of the money option, save yourself a little money, because when you do buy an option, your risk is what you pay for that option. So obviously, if you're paying less, your risk is less. So the net takeaway is most options expire worthless, so behave accordingly. It's generally better to be a net option seller. Spending a substantial amount of money on option premiums, typically a losing strategy in the long run. Now, this year's been really extraordinary because we've seen such huge and unexpected and unpredictable moves. I'm sure there are some people out there that had some option purchases that made a ton of money, and good for them. But that's in the big picture, that's kind of the exception, not the rule. Okay, so what we're going to do is take a look at some examples. These are some trades that we have put out on our newsletters and recommended to our clients. Some of them have worked out, some of them have not, but we're gonna show you everything in between. Let me just switch screens real quick. Okay, so you should be able to see a newsletter, the Carley Perspective. This is a newsletter that we write in-house for our brokerage clients. And basically the idea is we give them ideas and they can choose to participate or not participate. And even if they never do any of our trades, that's fine. It's intended to be a learning experience. So this trade was put out just a couple of days ago. Let me see, September 20th. So on Monday. And the idea is when we look at markets, we're looking at a couple of things. We're looking at seasonals, like what does the market normally do in any particular year? We're looking at the technical setup. We're looking at what the market sentiment is. So there's a thing in commodities called the COT report. It's the Commitment of Traders report. And it tells us who's long and who's short. And so we try to keep an eye on that to give us an idea of if a trade is overcrowded. In the case of sugar, it's not really overcrowded, but it suggests that a lot of the bullish speculators have liquidated, which means If sugar does have a reason to start going up, there's plenty of buying power on the sidelines to push prices up. And you can see on the chart here, this trend line dates back for a couple, about a year and a half, 2 years. And on late last week, or actually, I think it might have been Monday morning, we sold off really sharply. We touched trend line, but we closed above it. And so on that big sell-off, we decided calls were cheap at that point because the market was in a downtrend and everybody had kind of given up on the idea of sugar reversing. So we sent out a notice to our clients letting them know that the the 18-cent calls were trading at a discount to what they might normally, or what we thought they might be worth, and suggested maybe they consider buying them. Also, the seasonal setup in sugar is bullish. According to MRCI, I don't know if anyone's familiar with that, but it's More Research Center Incorporated. They are a seasonal service in commodities that's been around for a long, long time. And they have a lot of stats on which markets tend to move at which times a year. And they, according to their numbers, 13 out of the last 15 years, sugar has gone up basically from right about now through the middle of October. So seasonally, there's a pretty good chance this trade works out well. So you can see that we're not just looking at one thing, we're looking at a whole bunch of things. And even if we do all our homework and everything lines up, the stars align, it doesn't mean that the market's going to do what we think it's going to do. But the point is to put the probabilities in your favor and see what happens. So this particular trade was buying the March sugar 18 call. Sugar at the time was trading around 17.50. March options, I'm going to scroll down here to the lower part of the newsletter. You can see that the March options have expired February 15th with 149 days. So our strike price was 18 cents and sugar was trading around 17.50 or so, somewhere in that ballpark. The total risk on the trade was about 70 ticks. Now, some people were filled a few ticks higher, but for roughly $800, you get 149 days in the market. That's what I mean by being cheap. So this is a trade that is close to the money. It has a lot of time. So anything can happen in 149 days. I think we can all agree that these markets have been, anything can happen in one day, let alone 149 days. So there's plenty of time and the risk is limited and it's relatively low at $800 for that amount of time in the market. I think it's a pretty good deal. So in this situation, we've suggested this trade to our clients. It's not always that attractive to buy options, but sometimes it is. So you don't want to focus on, or you don't want to get in the mindset of you should never just buy options outright, because that's just simply inaccurate. You should strive to be cheap and be careful when you're buying options outright, but that doesn't mean never. So this is a similar trade in cocoa. Cocoa and sugar are not the most popular commodities when it comes to speculators, but every once in a while they pose some pretty good opportunities in our eyes. So we kind of had a similar idea in March cocoa. The market's been coiling. It's really been trading sideways since July after a pretty big sell-off. But it continues. This trend line that we have here drawn here goes back for a handful of years. So this is a really important pivot. You can see the market's tried to sell off a few times below it, but it just can't stay there. Like it breaks support, probably running sell stops, but then it bounces right back into this trading range. So in our view, there's a pretty good chance, much better than 50-50, that cocoa breaks out of this trading range to the upside. Again, no guarantees, but it's probably worth a shot. And if it does, we're recommending our clients take a look at the 2,600 calls for March cocoa. And you can see we were just there in June and in February this year, which may be a little bit of a pipe dream as far as where we go from here, was 2,800. So there's plenty of room for cocoa to move on the upside without a whole lot getting in the way until we get to about 2,370. Above that, we're probably looking at 2,600. Now we're buying a 2,600 call simply because we don't want to spend a lot of money. Okay, so if we bought a call option that had a strike price down here in the 2300s, it would be quite expensive. But this particular call we were able to purchase it for, I want to say about $700-800. Let's scroll down and look. Yeah, about $700. So again, it's a very similar setup to sugar. This is 141 days in the market for $700. Now, keep in mind, when you buy options outright, your profit potential is theoretically unlimited. That doesn't mean you should expect a whirlwind profits all the time, because like I said, most options expire worthless and most options erode in value with time. So this is a little bit, when you buy options, it's a little bit of a shot in the dark, but it's a really great way to get a foot in the door without having unlimited downside risk. And you know what you can lose no matter what happens. If cocoa goes to zero, you're only going to lose what you paid to buy the option. That's $7. Generally put out trades to just buy options because, as I've mentioned here in the previous slides, they tend to be, they're eroding assets and they tend to expire worthless. So you don't want to only be an option buyer usually. Now, sometimes it can work out, but it's a little bit of, they're a little bit of flyers. So this is the yen. We were recommending to buy it. It's again, similar idea of cocoa and sugar, buy really cheap call options that have a lot of time. These are March yen calls, so it's several months in the market. And I know the yen's had a really awful year, but you can see that there is a little bit of a trend line. Now, will it hold or will it continue to melt down? We don't know yet. As right before I got onto this interview, I read that the Bank of Japan is trying to intervene to stabilize the yen, which we have been waiting for that for a little while. So we thought it would happen before now, but here we are. And it just so happens to be on trend line support. So if things continue to go in this pattern, the yen should at least see 72.50, 73 on a rebound. And if the Bank of Japan is successful, then we may get a breakout that pushes us all the way back up towards the high 70s in the yen. Now, you might be confused because if you're looking at Forex or most of the TV stations are showing the yen not in dollar terms. This is in dollar terms. Most places quote it in terms of the yen. So it's a little bit confusing. This is basically the inverse of what you generally see on TV or in your Forex platforms, but it's the same idea. The idea is we think the dollar has a chance at strengthening against the yen. Now, we're also not silly. We know that the yen's in a downtrend and this has been a historical year and yen winked this. And so we're not looking to buy futures down here and hope for the best, because we don't want that unlimited risk. But buying a March call gives you 176 days to expiration. These expire on March 3rd for about $700. And again, 176 days is a lot of time. Anything can happen. I mean, this trade was recommended a few days ago. Let me see, September 8th. So actually like a week and a half ago. And the option's trading right around the same place. It hasn't really made or lost money. Even with the yen intervention this morning, the reaction wasn't what I wanted it to be. I was hoping for a much bigger rally on that Bank of Japan news, but it is what it is. Maybe it's a start. Maybe it'll at least get the shorts thinking. Because another thing to point out in the yen is the whole world is short. If you look at the COT report and look at sentiment readings, nobody thinks the yen can ever recover in our lifetimes. The sentiment is that bad. And so when everything is that lopsided, there's a pretty good chance at some point, everybody that's short, which is the majority of traders, the majority of global market participants, if everybody's short, at some point they have to buy their currency back to get out. So if and when we get that short squeeze, it could be really dramatic, and it might have nothing to do with fundamentals. It can just happen just because it needs to. People have to get out and square their positions. Okay, we're going to take a look at crude oil. And this is a trade that we put out on the 7th of September. So just a little bit of a backdrop here. This trade, crude oil has since kind of bounced around here a few times. We had some clients that did enter this trade initially and actually took a quick profit and have gotten back in. So that sort of thing is possible. Especially in crude oil, when you see a market that's bouncing like this, you do not ever want to be on the wrong side of crude oil. I mean, I've been there more than I want to admit. It's just no fun. And so in oil, it's generally a good idea to be quick to take profits. Don't get greedy. Don't worry about making swinging for the fence and hitting a home run. if you get a base hit in crude oil, it can be pretty nice. So take it and then rein in your risk and see what happens. And so that's what some of our clients have done. They're back in the position. I think last I checked, it's slightly profitable after on the second go around. So that's nice. But here's the idea of this trade. Now, I just told you that options mostly expire worthless. They're eroding assets. So here is one way to put an option spread together that counteracts that. Basically, the idea is we want to use the market's money to purchase an option. And that's kind of basically, it's as simple as that. Don't let everything, people tend to get bogged down on the names of the option spreads and all that kind of stuff. Don't worry about that. All you have to understand is with this strategy, we want to buy the 85 call, but we don't want to pay a fortune for it. I'm going to scroll down real quick and you can see the 85 call would cost you about, this is based on a few days ago. This isn't current, but my guess is it's a little more than that now. So this 85 call would cost you $7 grand if you bought it outright. So I don't know about you, but spending 7,000 on an option, keep in mind, if you spend 7,000, you could lose all 7,000. It may not happen immediately, but it could happen over time. And if the market trades sideways, it might be a really slow and painful erosion of several $1,000s. And that's hard to watch because the problem is when a market's trading sideways like this and you're long a call option, in your mind, you're thinking, well, I need to be patient. There's always a chance crude's going to go the way I think it's going to go. And of course, people wait. And what happens as the market's doing this sideways stuff, that option's eroding and you're just basically bleeding money as we go. So here's a way to play it that takes that away. There are some opportunity costs. So in this case, we could buy the 85 call, sell the 95 call, and sell a 68 put. You can see this is a bullish spread. I want to mention in the long term, I'm not bullish oil. I think oil's going into the 60s at some point next year. But in the short term, I think that $80 is going to hold. I think there's so many weird things going on globally, politically, that the oil market's probably going to hold $80 for now. So this idea is for those looking for a short-term bounce. And those bounces can be really big. I wouldn't be shocked to see crude oil bounce up here into the mid 90s. So, but this isn't a trade I would recommend holding on forever and definitely not to expiration, because if you get in and it holds 80 and you make your money, it's a good idea to take the money off the table and just walk away and see what happens. Because again, you don't want to be caught. If oil does break below 80, it could get pretty ugly and you don't want to be there for that. Just so you understand how this works, we're buying the 85 call, we're selling a 95 call and bringing in about $4,000. And then also selling a 68 put and bringing in about 3,500. So at the time of this recommendation or idea, this spread could have brought in a credit of $400. So not only are you buying the 85 call with the market's money, but the market is actually paying you to take that position on. So the market's paying you $400 to put this position on. Now, before you think that sounds like a spectacular deal and there's no way it could go wrong, here's the risk. Because we're using the market's money and because we're selling a put, which is naked, there's unlimited risk below 68. So if oil melts down below 68, now you can see we didn't just blindly throw this short option out here. If you're going to sell options with unlimited risk, you better make it worth your while. So you better collect enough premium for it to be worth it. And you better put the strike price at a price where you would be comfortable and you're relatively confident the market won't get there, or it won't get there so quickly that you can't react to it, I guess is more important. So this trade is saying, I don't think oil is going below 68 and I want to buy this call spread. So I'll sell this 68 put to pay for it. Let's look at the stats on a trade like this. This is a $10 spread. Now, because the volatility is so high relative to what we normally see, this spread is actually quite attractive. In a more normal oil market, you couldn't do a spread this attractive. And what I mean by that is, this is a $10 call spread. So we're buying a January 85 and selling a January 95 call. that's a $10 spread between our long call and our short call, which means if you hold all the way to expiration, you would actually make $10,000 on that call spread. I'm not saying anyone's going to hold the expiration. In fact, most people should not hold the expiration, but that's kind of the pie in the sky target. In normal markets, you might only get a $5 spread off. So with normal volatility, you might only be able to buy the 85, sell the 90, and then sell a put with a higher strike price. Because of the volatility, we're able to stretch out our short options enough to make a really huge profit potential and shift our risk quite a ways under the market. So this trade is a little different than the ones we just looked at. This expires in 99 days, which on a position like this, I think 60 to 100 days is kind of the target that you want to look for expiration. You can do these types of strategies with shorter expiration. So you could do this with the front month, that has roughly 30 days to expiration. But the problem with that is the options are priced based on the time value. Well, it's priced based on many things, but an option that has 30 days to expiration is worth less than an option that has 99 days to expiration. And so why that matters is if we were using 30-day expiration options, instead of selling a 68 put, we'd probably have to sell a 75 put. Instead of selling a 95 call, we'd probably have to sell a 90 call just to bring in enough premium to pay for our 85 call. So suddenly our profit potential is lower and our risk is a lot closer to the fire. And so I've found that it's better to use options that have some time on them so that you can stretch everything out, more profit potential, less immediate risk, or at least lower risk from a strike price point of view. And it takes a lot of the stress out of it. If you have oil's trading at like 82, so if you have a $14 cushion before you start running into your unlimited risk zone, as opposed to only a $7 or $8 cushion, the mental aspect is going to be quite a bit different. And you're going to probably make better decisions if you have this type of spread that gives yourself some room to be wrong. Now, if we're wrong about oil going up, but crude oil still stays above 68, basically all of these options expire worthless, but we still get to collect the premium we made, so $350 to $400. So this is a type of trade where you can be wrong and still actually maybe make some money, as long as you're not too wrong. If you're too wrong and prices go below 68, that's where you get into trouble. It's like being long a futures contract from 68. But as long as that doesn't happen, as long as it stays above 68, then you're really it's no harm, no foul on the trade. So that's the benefit of doing this sort of thing. Another drawback I should point out is at expiration, everything that I just said was true. As long as oil's above 68, your risk is really almost nothing. In fact, you don't have risk because you collected money. But before expiration, the value of these options can fluctuate pretty wildly. And so let's say that oil drops $10 in a day. Even if the price of oil never gets to 68, just the volatility and the chaos that ensues will create a situation where that put increases in value and your paper losses can be substantial, and it can be a little bit scary and stressful. So for this reason, these types of trades, you want to make sure you have a lot of excess margin available to do this. You can see the margin on this trade at the time was 6,600. I would recommend probably allocating about 20,000 to a trade like this. You can certainly do it with a $7,000, $8,000, $9,000 account, because I just showed you the margin 6,600. But the problem with that is if something odd happens and things get out of hand, you're going to quickly find yourself in margin trouble, and it's going to cause you some mental duress. If you have it in a $20,000 account, you probably are going to be able to ride out ebb and flows, panic days, that sort of thing. So you want to be real careful. Make sure you give yourself a lot of breathing room when it comes to margin. Also, crude oil options, well, I should say the CME, which is the Chicago Mercantile Exchange, they've recently listed micro options on crude oil. This is absolutely fantastic. So with the micro options, they're 1/10 the size of the full size contract. So all the numbers that you see here can be divided by 10, and that's what you would get as your figure. So in other words, for example, your credit would be $35 instead of $350. The margin would be $660. The risk is still unlimited, but under 68, you're long a micro future, not a full size. So if oil's at 65 at expiration, you're going to be out about $300 on that, on the future. So it's going to be a lot more manageable, a lot easier to handle, and it's a really great way for new traders to get an idea of how options work and practice this sort of a strategy and defending it if something goes wrong. So micro crude oil options are absolutely fantastic for something like this. Now, of course, it does cut the profit potential. So in this scenario, if we're using the full size crude options, the profit's about 10,000 plus what you collected in premium. So it's a little more than 10,000. If you're using micro options, everything is divided by 10. So you're only getting, your maximum profit is only about $1,000. But if you make $1,000 on a margin of $660 and relatively small risk, I mean, crude oil would really have to pump well below 68 or you to get in trouble on a micro. I mean, anything's possible. We just saw crude in 2020 go negative, so anything's possible. But even if crude went negative, you'd only be out $6,800 on a micro. So obviously that's a lot of money, but the odds of crude going from where we are now in this environment to zero are probably slim to none. So I'm just trying to give you an idea of how that might work. Okay, let me see what else we've got here. I'm going to show you a similar strategy in the S&P. Now, this has been a pretty wild market, to say the least, especially with the craziness we had yesterday with the Fed meeting here in the US. So this was put out a little while ago, September 6th. So we're talking 2-3 weeks ago. And kind of the same situation as crude oil. We had some clients get in and take a quick profit because after entering this trade, the market did rally as we expected. I am very thankful that we encourage people to take profits and get to the sidelines because all heck broke loose. Right? It turned and it turned hard, and it's been a wild ride since. Now those clients have gotten back in and are a little underwater, but I think the idea is still the same. I think it's still a pretty good trade, but it's going to be hairy in the next couple of days. So it's the same idea as what we just did in crude. We want to buy a December 4100 call in the S&P 500, but we don't want to pay for it. At this time, the 41 call was 116 points. If you've ever traded the S&P, you know 116 points is $5,800. So it costs you almost $6,000 to buy that option. Nobody wants to spend $6,000 on an option, or I don't anyway. So to pay for it, we can sell the 43 call and we can sell the 34.50 put. And you can see the low in June, you hear a lot of people talking about the stock market needs to retest lows. And that very well may happen. If we do retest lows, my guess is we go a little lower. We probably go to 35.50. And so that's why we put this option down here under 3,500, because if we're wrong and this trend line doesn't hold, which at this point it's kind of trying to break through, we want to give ourselves room all the way down to 34.50, which is below what we think is the worst case scenario of 35.50. Now I say we think it's the worst case scenario because nobody knows. The worst case scenario is zero, and then in 2022 I would not say it's impossible, but this is going to give us a lot of room to react if something goes wrong. So again, let me show you what that looks like on paper. Buying the 41 call because that's the option we want to make money with. And then we sell a 43 call at a 34.50 put to pay for it. In this scenario, the cost is about $500. So we're actually paying to get into that spread. So we're collecting enough premium to cover most of the cost of the long call, but not all of it. At the time, this would have given a trader 101 days in the market And remember, I said we kind of like the idea of roughly 60 to 100 days, simply because you're able to put a spread together that's wide and you have a lot of room for error. I mean, 34.50 is not impossible. It could happen, but it's not necessarily likely. And if it does happen, it's probably not going to be right away. And so that should give us plenty of room to ride all the chaos out and react if we need to. The risk is unlimited below 34.50. So if the market goes down to that area, it's like being long a futures contract. And that's going to be unpleasant if the market's really crashing like that. Now, everybody talks about stock market crashes, but the reality is they're pretty rare. I mean, I've been doing this for a long time, since 2004, and I've lived through the financial crisis, the flash crash in 2011, and COVID, obviously. And those are about the three events that have really caused what might be categorized as crashes. And we're talking that's over a span of almost 20 years, 16 to 18 years. So yes, stock market volatility can get really intense, but it doesn't happen as much as everybody wants to talk about it. That said, in this particular cycle, the markets were really, really frothy going into the start of 2020 or the end of 2021. So it's not shocking to see some volatility, and honestly, we may not be quite done. But I do think there's a lot of money. This is just my opinion. From what I've read and what I see, there's a lot of money on the sidelines, because the Fed is tightening conditions. They're raising rates and they're pulling some money out of the economy, but they're pulling it out much slower than they put it in. And they're really just making a very small dent. So there's a lot of money still sloshing around out there. A lot of it's sitting in cash, and it's going to have to go somewhere. I think it might go to gold. I think it might go to treasuries at some point, although treasuries are having a rough time. And I think it might go to the stock market. And it once the sideline money starts coming in, a lot of these assets can really start moving higher pretty sharply, and it might shock some people. So back to this trade, the maximum profit's about 9,500 if you hold it to expiration. Again, I don't recommend holding anything to expiration, because just because the market's, let's put it this way, if you're in a trade that lasts 100 days, let's say the market goes in your favor the first 10 days of the position, and you can take a nice respectable profit. If you can take a nice profit in 10 days, why would you wait another 90 days to see what happens? Because the market might go your way in the beginning, but there's no guarantees it's going to stay up. You don't want to turn a winner into a loser, and you don't want to get greedy. A lot of people try to get greedy and squeeze out the maximum profit, but the maximum profit is just there to give you an idea of what is possible, but the odds of you achieving that are very slim, and it's probably just at some point it becomes more risk than reward. So what we would suggest to people is, if you're making 2, 3, 4 grand on this position, just take it. You might even have a chance to get back in, which is kind of what we've had on this particular occasion. It's always better to take profits off the table if you have them and reduce risk, because profits aren't guaranteed to stay profits. The market can give you something and take it away a lot faster. I'm going to take a quick look at one more trade. Now, this is a trade that's gone actually relatively poorly, and we've adjusted. This was sent on August 29th, and it's a position in gold. The gold market has just been pathetic. I mean, I don't really have another word for it. It has been just an atrocity. You would think with on the eve of war, and with all the inflation and all the things going on, the stock market having a rough time, you would think people would look to gold as some sort of a diversification tool against some of these things that are going on. But that just absolutely has not been the case. Gold has just not been able to get out of its own way. So this was a position that we had recommended in late August. And same strategies we've seen in the last couple of trades. The idea is we wanted to buy an 1,800 gold call, which would cost roughly $4,800, but we didn't want to pay for it. So we sold some premium around it, a 1,900 call and a 1,650 call. Just to make, I should have mentioned this earlier, but just so everybody understands, when you sell a call against a long call, you're basically capping your profit potential. So there's no risk on the upside. If gold goes to 2,000, you're not going to benefit above 1,900, but you're still fine. You're not losing money above 1900 because your 1800 call and your 1900 call basically wash each other out above that price. So you're just capping your profit potential. So it's which is the opposite of selling the opposite side. So on the put side, we don't have any long puts. We're only short a put, so our risk is unlimited. So this trade was using the January options, not the February or March. These are January options. And we're buying the 1800, selling a 1900, and then selling a 1650 put. The trade ends up costing about $400. Our risk is below 1650. At the time this was put on, we were of the belief that this trend line was going to hold and gold would break out, and that just did not occur. In fact, we sold off sharply down to this area. So we basically retested this low, and we're in the process of seeing whether or not that will continue to hold, or if gold is just a lost cause and it's going to continue to melt down. The jury's still out. We still believe it will work, but what we've kind of advised our clients to do is adjust their positions. So in these types of situations, sometimes you're just flat out wrong, and you can make a choice whether to exit the trade or adjust it. And we've decided to recommend to adjust it to those that want to. And the adjustment was buying back the 1650 put, which had gained quite a bit of value and was showing a pretty big paper loss, I think roughly around 2,000 to 2,500. And at that point, if you buy that back, we were able to sell a fresh strangle. So we sold a 1600 put. So we rolled our risk down, just giving the market room to move. And then we also sold an 1850 call. And we also bought back the 19 call. So because the market went down, this 1900 call lost money. I'm sorry, the 1900 call made money. So we bought that back at a profit. We're losing money on the 1800 call and the 1650 call. So we took a loss on the 1650 call and then replaced that premium with a short 1600 put and an 1850 call. And what that does is it shifts our risk lower. So now instead of having unlimited risk under 1650, it's under 1600. But the opportunity cost was, instead of making $100, which is 10,000 in gold, we can only make 5,000 if everything goes perfect from here. But I think at this point, capital preservation is more important than trying to have the largest profit potential. So sometimes you just have to concede a little bit. And of course, if gold continues lower, then we're going to be in the same situation we're in now later down the road. So we don't think that's going to happen. We think gold will find a way to at least put a temporary rally together, but we'll see how it goes. So these things don't always work out as planned, and they can be quite stressful. Like in this situation, gold never traded below our 1650 put, but it didn't matter because of the volatility and there was such a large sell-off in gold. This put gained in value very quickly. The long call lost a lot of value, and our 1900 call helped out a little bit, but not enough to really take most of the pain away. So I think at the worst case scenario, this trade was down about $4,000, which is a lot. That's a lot to stomach. But when you're doing these types of trades, you have to keep in mind, like, your profit potential is pretty large. In this situation, it's $10,000. Your margin's $4,000. So a $4,000 drawdown is pretty terrible to look at, but that's what you can expect when you're doing these types of trades. If something goes wrong, that's pretty par for the course. There's a reason the exchange sets margins the way they do. If you're interested, the exchange margin rates are basically what the exchange thinks is maybe the worst case scenario in a single trading session. So that gives you an idea. If you can't stomach that sort of a drawdown in a day or two, probably not the trade for you. So unfortunately, there's no micro options for gold. In this situation, if you want to do this trade, you have to go with the full size contracts, and it's not for everybody, but maybe just a learning experience. So that's pretty much all I have for the trades. Let me see here. Yeah.
I think we've done some in-depth analysis based on your presentation to help us understand more about how you conduct your trades. So for now, I'm going to open for Q&A if you have any questions.
Okay, perfect.
And then we can finish up. for this particular one. Thank you so much. At least today we really understood how you actually do your trades. So my question would be, today there'll be like a meeting with the European Central Bank Committee. Is their report going to affect your trading in any way?
Well, we've had a slew of central bank news and announcements in the last couple of weeks. So what we've tried to do with these positions that we just kind of went over is, the thing is you have to be in it to win it, right? So if we wanted to be completely out of the market for every central bank announcement, then we would never have any exposure and never make or lose any money, which is fine. I mean, honestly, that's probably not the worst place to be. But so it's not going to change anything we do, other than we're just going to be on high alert to hedge things if something goes wrong. So I mentioned in that gold trade, we had to adjust. We may have to do that in crude oil, or maybe even the S&P trade, if things continue to just get really wild. And so we're on alert, but it's not going to change anything that we have on. And it probably, honestly, because of the Fed meeting, and because of ECB and all the stuff going on, we've kind of shied away from putting anything new on or recommending anything new, except for in like sugar and cocoa, markets that are not directly affected by those sorts of things.
I can't see any questions from the participants. So thank you so much, Carley, for today. We really appreciate your time. And of
You're
course,
welcome.
We'll give you this recording and have it uploaded on our YouTube channels. And people, if you want to get in touch with Carley, her details we'll link them on the trading podcast bio. Thank you so much, Carley.
Thank you. Sure, you're welcome. Thank you for having me.
See you in the next one.
Okay, will do.
All right, bye.